Hello and welcome to Buying a Home in 2022. I'm your presenter, Jeff Eisenberg. A little bit about me is I graduated from California State University Northridge with a business administration degree. I've been in the business for over 25 years. I previously worked at Bank of America as a preferred banking officer and a major accounts district manager for ADP Payroll Services. I'm the owner, broker of Southern Oaks Mortgage, Inc., and I'm a local resident of Santa Clarita since 1989. So let's talk about what we're going to cover today. First thing we're going to cover is the current market condition. What's going on? Secondly, is now a good time to buy? The benefits of homeownership, credit, qualifying for a home purchase, the loan estimate and other lending terminology, low down payment options and other loan programs, advantages of using a mortgage broker versus a bank or direct lender, and what to look for in a real estate agent. So let's get started. So what are the current market conditions? Well, we have rising inflation. So basically, as inflation rises, interest rates will rise. If inflation goes down, interest rates go down. That's typically how it works. And we are in a rising inflation situation at the moment, unfortunately. We have low inventory, which is causing increase in the housing prices. So there are more buyers than there are houses for sale. So that's causing a little bit of pressure on houses being worth more, although that is now leveling out. We see rising interest rates and home affordability going down. So as the rates keep increasing, the amount of home you'll be able to afford is going to be going down. For instance, if you buy a $500,000 house today with rising interest rates, you might only be able to afford a $450,000 home as the rates increase. So that's something, the environment we're in right now. First-time buyers and non-occupant co-borrowers. We are seeing a lot of first-time buyers out there buying homes. A lot of millennials are buying homes that weren't buying homes before. And non-occupant co-borrowers, and those are people that buy a house co-sign with somebody but don't live in the property. That's the non-occupant. They don't live in the property, but they are co-borrowers. We are seeing a rise in that. That means people can't afford the house, so they get a qualified relative or friend or somebody to co-sign with them as a non-occupant co-borrower. We also see a recession looming, and the question is, are we already there? I do think we've already hit the recession. I mean, we're not fully into it yet, but it is the beginning of the recession at this time. So all those things make a difference. And then the Fed funds discount rate and prime rate are on the rise right now. So what the Fed funds and the discount rate are is that what banks lend to other banks overnight, and what the Feds give to member banks of the Federal Reserve. And then the prime rate is what affects consumer debt. So that's like car loans, home equity lines of credit, credit cards. The higher up those go, it's going to be tougher to obtain credit. What the Fed does is they try to, when they raise rates, they're raising these three rates. The Fed funds and the discount rate is supposed to hedge inflation. And again, if inflation goes down, interest rates go down. So their goal is, when they raise these things, is to try to hedge inflation and bring it down. So the next thing is now a good time to buy, or is it not a good time to buy? Well, let's talk about that for a second. Rates are high, but they will come down. You can always refinance to a lower rate when they do come down. So a lot of people don't understand this, but right now it's actually better to buy with a higher interest rate and get the right value for the house than it is to spend $50,000 to $100,000 more for a house at a lower interest rate. So that's what people were doing previous to this, the rates going up, is they were buying houses $50,000 to $100,000 over the asking price at the lower rates, at 3.5 or whatever interest rate. But the reality of it is, if they would have bought it today at $50,000 to $100,000 less and got a higher rate, it would have actually been better for them. But when rates go up, they usually come down. So in a recession, rates usually come down. So there will be the opportunity to refinance and get those rates back down. You also, if you buy now, you can start creating a savings plan. A lot of people don't realize this, but when you pay a landlord rent, they get the money and it all goes to them, and they're actually getting richer. When you own the property, a portion of your payment goes to principal and a portion goes to interest. Well, the amount that you put toward principal is actually lowering the amount of your balance on your loan. So you might have borrowed $500,000, but every single month you're putting a little bit, I call it a savings account, you're putting it towards your own house, and you're increasing your equity because your balance is going down, as well as the value of your house might be going up. So you're actually making money on your own home by putting away every month this principal towards your balance. So values may go down slightly during this period of time that we're in right now, but they will eventually go up. I mean, buying a house has always been a positive thing. I mean, if you look at all the wealthy people in the world, most of them have created their wealth from real estate. So you are better off, and this is what I was saying earlier, you're better off buying at the current value at a higher rate, than paying $50,000 or more over the asking price at a lower rate. So of course I believe now is a good time to buy. Should you buy a starter home? That's another thing that a lot of people are avoiding now is, if you're a first-time buyer, you probably want to buy a starter home. A starter home is a home that you can afford, that's affordable to you. I've come across many clients that, they've never bought a house before, but they're shooting for, $1 million homes, and they're going after $1 million homes as their starter home. A $1 million home typically is a home more like one that's a forever home that you're going to stay in forever. So, it depends on your situation, and I'd have to talk to you about it, but sometimes, if you can afford it, you're brand new, you just got out of college, you've got a really good job, and it's only going to go upward from there, then you're more likely to buy more of a forever home than a starter home. But, I bought a starter home. My first home was $130,000. My wife and I were making $60,000, and that's what we started with. And we ended up keeping it as a rental for 17 years, and it was fantastic, and I made a lot of money on it and bought another house after, in the meantime. So, keep that in mind when you're buying. And also, if you already own a house, is now a good time to move up. If you have a growing family or your income's increasing, you might be in a small house, you might want to increase it. Now's a great time to buy, because even though the interest rates are high, you have that automatic savings plan that puts the money into your equity, and then hopefully over the next 5, 10, 15 years, the value of the home's going to go up and you're going to make a lot of money. And then also now's a good time to buy an investment property, another savings plan for the future. Again, if someone else is making the payment, you're getting your principal and interest and you're putting it down. Someone else is paying down your mortgage. You're not really paying anything. Could be a very, very good opportunity to buy at this time. Okay, so let's talk about the median home price in Santa Clarita. Now, I know whoever's listening to this might not be in Santa Clarita, but I can also run the numbers for whatever area you are in. You just have to reach out to me. But let's look at this, because this is really interesting. So in December of 17, condos were at $345,000. Houses were at $580,000. In 2022, this is March, condos went up to $605,000 and houses went up to $850,000. So on condos, we had a 75.4% increase. And on homes, we had a 46.6% increase, and that's just in 5 years. So as you can see, buying a home has always been a good investment. I bought a rental property in Oxnard for $285,000, a condo, and now it's worth about $500,000, maybe $515,000. and they're paying the mortgage for me. I'm not even paying a dime out of my pocket, and they're every month when I put principal and interest, the principal brings down my balance, and I get richer every single day that they're making the payments for me. So very important to look at this from the perspective of what's in it for you in the future. Okay, so let's talk about benefits of home ownership. So the first one is tax deductions. When you buy a home, you can write off the property taxes and the interest. And that usually adds up to a significant amount. I mean, it can be as high as $30,000 that you'll be able to write off of your taxes. And you also, because of COVID, a lot of people are now working from home. So if you're working from home and you use part of your house, even if it's 10% of your house as business, you can write off 10% of all the expenses that you are paying on that house. Now, of course, don't take my word for it. Talk to a CPA or your tax accountant and find out for yourself. But that's one of the benefits of owning a house. Secondly, you have security for the future because of that forced savings account. Every time you make your payment, a portion goes to principal, and that's putting money away for you for the future. And then it's a sound investment. Again, long term. Look at the previous screen that showed Santa Clarita Valley and how much houses have gone up. I mean, it's crazy how good of an investment this is. You can't really get this anywhere unless you have a stock portfolio that can produce double digits earnings per growth every year. I mean, buying a house or owning is far superior to most investments. Okay, now let's talk about credit scores and what do they mean. So this is a very interesting little thing here. Credit scores range from 350 to 850, and they're comprised of many different factors. So let's talk about those factors for a second. So you have 35% is based on your payment history. Is it a good payment history? Do you miss payments? Do you have 30-day lates? Things like that. 30% is about the amount owed on your credit cards and your debts. So you want to keep your outstanding debt at about less or so than 25 to 30% of your outstanding limit. So if you have a credit card that's a $10,000 limit, you don't want to owe more than $3,000, roughly 30%. That'll keep your score high. 15% is the length of credit history. How long have you had credit history? 10% is the type of credit you have. Is it an auto loan? Is it a mortgage loan? Is it credit cards? Is it a lease on a car or equipment or something like that? And 10% is also on new credit. So you do have to occasionally get new credit every once in a while to keep your score at its peak. So here's how your score looks to a lender. So if your score is 740 plus, you basically have A plus 5 credit. You're excellent credit. Get the best rates. At 720 to 739, you're A plus 4. 700 to 719, A plus 3. 680 to 699, A plus 2. 660 to 679, A plus. 640 to 659, A. 620 to 639, A minus. 600 to 619, A double minus. And below is any of that is hard money, and you're looking at higher down payments, much higher rates, and costs a lot more expensive to get. So as you can see, it really does matter where your credit falls in this scale of scores, because at each one of these levels, you get a better rate. So at 740, you're going to get the best rate. But if you're at 700, you're already 2 below the best. So you're going to not get as good of a rate or rebate that the lender would give you based on your credit score. So you always want to check your credit, make sure your credit is in tip-top shape. I meet with clients all the time and just discuss credit and how they can improve their credit. So it's very important to keep your credit scores high. All right, so let's talk about qualifying and what a lender analyzes. So the most important thing that they look at is your income. That's number one of everything. What they're looking at is your income to housing expense ratio. Okay, let's talk about that. So there's this thing called PITIA, principal, interest, property taxes, insurance, and association dues if you have any. That's known as your housing expense. Okay? Now, to calculate what's called a front end ratio, because there's two ratios we consider, a front end and a back end. The PITIA divided by the gross monthly income, that's your front end ratio. Okay, and let's look at an example. So for instance, this Mr. Jones, the loan amount's $594,041, interest rate 4.25. His PITIA, his housing expense, is $4,016. His income is $10,000 a month. So to calculate his front end ratio, we take the $4,016 divided by the 10. He's at about a 40% debt to income ratio. Okay. The most important ratio is this one, the income to total debt ratio. And this is taking the PITIA, the housing expense, plus all other monthly obligations. So for instance, car loans, student loans, minimum payments on credit card debt, all those things, and then dividing that by the gross monthly income. And that's known as the back end ratio, and that's the most important, and that's the one that you really can't go above 50%. So 50% of your income cannot go more, more of that cannot go towards debt. So basically for every dollar you have in debt, you need $2 in income to offset it. So let's look at an example. So same situation, Mr. Jones, his housing expense is $4,016, but he has $550 a month in other debts like car loan and maybe a couple credit cards. So his total debt is $4,566. You're going to divide that by his $10,000 income, and he's at a 46% debt to income ratio, and he would qualify for a home loan. Okay, so now why pre-qualify? Why do you need to do this? It's very, very important, and I'll explain it as we go on. But you want to know where you stand, what your payment is, and the money you need to close. Because if you don't know this ahead of time, how do you know you have enough money? How do you know you can afford the payment? Just because, if I tell you your payment's going to be, $4,500, you may be able to afford that, but don't you think you should know that before? Because you may say, I don't want payments over $3,500. So you need to know these things, and that's what the pre-qualification process does for you, is it lets you know what you are qualified for. And the second reason is the seller's acceptance of your offer is increased when you get pre-qualified. I personally recommend getting pre-approved. The difference between pre-qual and pre-approval is a pre-qual is just you've talked to a mortgage broker like myself or a banker. They've looked at your stuff and they said, okay, based on the numbers you're telling me, I can qualify you for this. A pre-approval is you've given them your bank statements, your W-2s, your tax returns. They've ran your credit so they can see what minimum debts you have. And then they tell you what you qualify for. That's a much better way, and I recommend doing that better than the pre-qualification. And then it's also a smoother escrow process, less uncertainty, less time, because everyone already knows, you can qualify. Nothing's worse than getting into an escrow and fighting with your lender the whole way through to try to get the loan through when you could have avoided it by getting pre-qualified or pre-approved at the beginning. Okay, so now let's go over some terminology. So one of the most important things you're going to get when you apply for a loan is a loan estimate. And this is an itemization of estimated fees and charges required to close your loan. So it's everything in a nutshell of how much money you're going to need to close your loan, your down payment and all the closing costs. And this is what it kind of looks like. So the loan estimate will tell you things like the interest rate, the loan amount, what your monthly payment's going to be, and how much estimated cash to close you're going to need. The second page breaks down all the individual fees. It's a very important document and a little bit hard to understand, but hopefully, if you have a good mortgage broker or banker, they'll be able to explain it to you very well and you'll understand it pretty easily. Okay, there's something called loan origination fee, and also known as points. So let's talk about that for a second. This is a one-time charge by the investor which adjusts the yield on the loan to what the market conditions demand. So what that basically means, the yield is the interest rate and the market demand is you. So for instance, if I say today's rate is 5% no points, You may say, I don't want 5%. I want 4.5%. Well, you can buy down the rate, and you're the market, so you're the market conditions demand. That's what you are, and you say, I want 4.5. Well, it might cost you 1.5, 2 points to get 4.5. So you have to decide, is it really worth doing it? So each point is equal to 1% of the mortgage amount. So an example would be if one point of $650,000 loan is $6,500. So this is what gets tricky is, if you're not dealing with a really quality mortgage broker or banker, you could be paying these things and you really shouldn't be paying them, because you have to realize that if you're going to pay 1 point, $6,500, and you how much is that saving you per month on the interest rate? So let's say you're at 5% and your payments, I'm just throwing out some numbers here, but let's say at 5% your payment is $3,000, but at 4.5 it's $2,850. So that's a difference of $150. So now you would have to actually figure out how long it's going to take to recuperate that $6,500. So you pay $6,500, you divide that by the 150 that it would save you. It's going to take you 43 1/3 months before you would even break even by paying that $6,500 to buy down the rate. And the problem is we don't know are you going to be in the house for at least 4 years? Are you going to refinance before the first 4 years? Those are things we don't know. And if you pay these points and you don't recuperate it by the 43 months that it takes, then you've kind of thrown money out the door. So those are things you really need to understand and talk to your mortgage broker or banker with. Okay, next fee we're going to talk about is the appraisal fee. This pays for a statement of property value prepared by an independent property appraiser. Appraisers now work for these things called AMCs, appraisal management companies. The lender picks which AMC they want to work with, and then the AMC randomly chooses the appraiser. So the best way I can explain it is you have a dartboard and you throw a dart, and that's the appraiser that you get to do your appraisal. It's not like it used to be where you could just call up an appraiser or someone and have them go out and appraise it. It all has to be done through this appraisal management company. And appraisals usually cost between $475 and $750. Okay, I wanted to go over these 3 particular fees because I thought they were very important fees. The first one is the inspection fee. When you buy a house, you should always do an inspection. That's having like a home inspector come. It's like sometimes they're general contractors, but they don't have to be. They're usually certified, and they're $350 to $500, but they'll come and they'll go through the house. They'll take 2 to 3 hours, go through the house, every single thing. They'll check the plugs, they'll check the electrical, they'll check the pool, they'll check the roof, they'll check inside the attic. They'll check all the outlets. They'll check, all the leaks and anything like that. And usually you have to pay for this out of pocket once you're in escrow and you're buying a house. That's a fee you have to pay for. Home warranty fee. I always recommend that you get a home warranty, whether the seller's paying for it or whether you're paying for it or your agent is paying for it. You want to get a home warranty because when you buy this house, if the washer and dryer goes out or the air conditioning goes out or something major goes out in the first couple months or first year you're in the house, having a home warranty, you only have to pay $75 for a service call and they'll come out and they'll fix it. There are exclusions and things like that, but at least look into a home warranty for sure when you're buying a house. And that's another fee that can be paid for by you, the seller, or your agent. And the third one is a pest inspection. Usually when you're buying a house, you want to make sure that it doesn't have termites or wood damage. A lot of houses have termites and wood damage, and that can be very costly if it has to be tented. They might have to tent the house, and that could be $3,500 to tent the house. So paying $95 to $125 to get a pest inspection is very well worth it. Okay. All right, so now let's talk about the credit report fee. This fee covers the cost of a credit report, which details your payment history with previous and past creditors. So obviously we have to have this, the lender needs to have this to verify that you're creditworthy and so forth. And the cost of this is between $34 and $60 depending. Then we have what's called prepaid interest. and this is also an important thing, but it's paid at the close, the settlement, the close of escrow. It's a charge that represents the interest that accrues from the day you close your mortgage to the end of the month, or when your first monthly payment's due. So mortgages are always in the arrears. So when you make your July 1 payment, it's the interest that accrued in June that you're paying for on July 1. So when you're doing an escrow and you close on, let's say, July 15th, you're not paying the interest from July 1 to July 15th because you didn't close until July 15th. You're paying the interest from July 15th until August 1st, because your normal first payment would be August 1st. So basically you're prepaying your August 1st payment 15 days, and then your next payment is not going to be due until September. So you actually technically skip a month. You pay for it at the close of escrow with this prepaid interest, but your first payment on the actual mortgage won't be until September 1st. So that's kind of how that works. Mortgage insurance. This is a very important thing too, is it's a monthly fee charged to the borrower, to you, to pay for insurance that protects the lender's interest, not your interest, the lender's interest, when you put down less than 20% or have less than 20% equity in your home. So if you're putting down 10%, 5%, you're going to have mortgage insurance. And it protects the lender in case you default, because you're not putting down enough money according to make it safe for the lender to not have this insurance. There are now ways to avoid the mortgage insurance with something called LPMI, lender paid mortgage insurance. That's where you pay a higher interest rate, a little bit higher interest, I think maybe 1/8 or 1/4% more, but you don't have the monthly mortgage insurance. Sometimes it works out better. I'd have to run a scenario, but the other option is restructuring your loan, where your financing is on 80% first with a 10% second, and then the 10%, the other 10% is your down payment. Or you can do even 5%. You can do an 80% first, 15% second, and 5% down. As long as your first is 80% of the, you have 80% loan to value, you definitely won't have the mortgage insurance. And it can come off. It usually takes 2 to 5 years to get the mortgage insurance off if the value of the house has gone up. And the cost is determined based on the loan amount and your FICO score. So those are things that, depends on how that all pans out. Taxes, insurance, impounds. So what this is these are funds held in an account by your lender to assure the future payment of your property taxes, your hazard insurance, and mortgage insurance, if you have any. The lender determines the amount that must be placed in reserve in order to pay the next insurance premium or your property taxes when due. It is often referred to as an escrow account. So you can choose to have tax and insurance impounds, or you can choose not to, as long as you put 10% or more down. If you're putting less than 10% down, the lender requires your taxes and your insurance to be impounded. If you put more than 10% down, you can choose on your own to have it taken out every month. And they take 1/12 of your taxes, 1/12 of your insurance, put in these little buckets, and then when your taxes and insurance are due, the lender will pay it for you. It's a nice way of basically forcing you to save the money to make these payments, because when the taxes and insurance come due, they come to due twice a year, you're going to have to pay that out of pocket if you don't have it saved up. And if you're not a good saver, it's better to have the impounds and have it set up this way from the get-go. Now let's talk about reserves. Reserves are monies that you must have in your account. Can be a checking, savings, 401k, stocks, bonds, mutual funds, doesn't matter. Typically the lender requires 2 months of your new housing expense, so that's the total housing expense, PITIA, as reserves, or 6 months if it's an investment property. So if you're buying a house and your payment's $4,000, well, let's look at this example. In the previous example, the housing expense was $4,016. So you would need 2 months of reserves, which is $8,032, in some kind of account after we were able to close the loan. So you'd have to show that you have a savings or a retirement or something that has at least $8,000 in it. And if you're buying an investment property, you have to have 6 months of the investment property's housing expense in reserves as well. And most lenders do not require reserves anymore, but for sure, if it's an investment property, they always require the 6 months. But most of the lenders now have gotten rid of the reserve requirement, the 2 months reserves. Homeowners insurance and hazard insurance, basically the same thing. This is required insurance that covers the cost to rebuild your house in the event of a fire or total destruction of your home. Earthquake insurance is usually an additional cost, but not typically required by the lender. So you don't have to have earthquake insurance if you don't want to. The typical cost is about 1/4% of the loan amount. So whatever your loan amount is, multiply it by 1/4. That's usually your annual premium on your homeowner's insurance, roughly. All right, so escrow and settlement fee. Those are basically synonymous with each other. This fee is paid to escrow as an administrative cost for ensuring the proper and unbiased execution of the contract as instructed by all parties. So basically, escrow's job is to take the purchase contract that you filled out when you bought the house and follow it exactly how it was written. Charge you for things that you as a buyer are going to pay for, and if the seller's paying for anything, make sure the seller pays for it. They're also in charge of making sure that everything goes smoothly and the transferring of funds and the title from one person to the other person. The cost of this is usually $2 per thousand of the purchase price plus a $350 fee. That's typical price, but sometimes it's lower, sometimes it's more, but that's a good estimate. We also have title insurance, and title insurance is a one-time fee premium charged at the close that protects the lender and or the borrower, so it protects you too against any losses due to title defects. Well, what's a title defect? Well, that comes to things like a mechanic's lien or a federal lien, or there's other things that can be put on the house as well. But when you buy the house, you want to make sure that the title to the house is clear from any encumbrances, because you don't want to buy a house that has a mechanic's lien on it from, let's say, a roofing contractor came to the previous owner, put a roof on the house, and the seller never paid him. So now he files a mechanic's lien on the house, and that house can't close escrow because until that contractor gets paid. Now the problem with this is if you didn't have title insurance and you bought the house with the mechanic's lien on it, it doesn't go against the seller, it goes against the property. So if you own the property now, you're responsible for paying off that lien. So very important to have title insurance. You can't really get a loan today without title insurance. All right, so let's talk about some loan options and go from here. So let's talk about fixed versus adjustable rates. So fixed rates are fixed for the term of the loan. So if you're doing a 30-year fixed, it's fixed for the full 30 years. You don't have to worry about interest rate hikes. No hikes, it's eliminated. Your risk, you know what you're getting. It's a set payment. Your consistent payment. And what I did here is I put adjustable in red because, it's a little scary, right? Adjustable rates. Basically, they change with the market. So if the interest rates change, your rate can change and you can have a higher payment. The risk on an adjustable is far greater. The payment can constantly change. Now, here's something important to understand is when you get an adjustable rate, the amount and the times of the adjustment are agreed at the time of the inception of your loan. So there's a bunch of different kinds of loan options out there for this, and there's something called a margin, and the margin is a set amount. So let's say the margin is 2.5%. Well, your margin is set at 2.5% and it can never change. But then you have an index. The index is what's the variable part of the adjustable rate. So the index could be, the LIBOR index, it could be the SOFR index, it could be the T-bill index, whatever the index is. That's the thing that goes up and down every, it can go daily every single day. But the times that your rate can change are all determined at the beginning and the inception of the loan. So typically your rate can change only 2% a year, and some loans are every 6 months 1%. It can go up or down 1%, but maximum 2% every year. And then they also have lifetime caps, so you might never exceed 5% over the start rate. So let's say your start rate is 4%, you never go above 9%, which is 5% over. So your rate could go anywhere from 4 up to 9, and then it could also go below 4 too if the index plus the margin is lower than the 4%. And then the last part I put in green again is because if you do this type of loan, you can save thousands. You just have to get lucky. There's no way to know, but it can, because the payments on these are usually lower because the fixed rate's a higher rate. Usually adjustables, you get a little bit lower rate. So very, very interesting how these things work. Now let's go over a couple of different adjustables. So these are called the 3.6, 5.6, 7.6, and 10.6 ARMs. ARM stands for adjustable rate mortgage. So basically, this loan is fixed for either 3, 5, 7, or 10 years. So it's an adjustable, but it's fixed for the first 3, 5, 7, or 10 years. The interest rate is usually 1/4 to 3/4 less than the 30-year fixed rate. The rate cannot change during that time frame. So you're locked in. If I gave you a 5.6 ARM and you're locked in at 4%, you're at 4% for all 5 years. At the end of the 5th year, it would then adjust. So basically what happens at the end of the 5th year, it converts to an adjustable, and depending on the loan that you get, it can either go up 2% or 5% in the very first year, the first adjustment, and then thereafter it can go up 1% every 6 months or 2% a year max, or 2% down, 1% every 6 months. The 6 in the 3.656 means that it can change every 6 months, maximum 1% thereafter. Great for first-time buyers who want lower payments. I mean, these are great loans, especially if you're only going to live in the property for like 5 years. I always recommend maybe doing a 7-year. Gives you an extra 2 years to, if you changed your mind or you didn't sell it in time, you can still have 2 more years at the same fixed rate. But you know, these can be very good loans. You just have to really talk it over with your mortgage professional and make sure. And again, you can save thousands over the fixed term because, you know, the fixed rates are higher by usually 1/4 to 3/4 of a point. So these can be really good loans. So now let's talk, oh, and there's no penalties to sell or to refinance on these particular loans. Let's talk about FHA loans for a second. FHA loans are nice because they're Federal Housing Administration. That's what it stands for. They are government insured loans. You can put 3.5% down, and it can all come from a gift. So if you have a family member, a parent, whatever, and they want to gift you the full 3.5% down, they can do that. You can also have a non-occupant co-borrower. So a parent, a relative can co-sign with you. They'll be on the loan, but they do not have to live in the property, and you still get primary residence rates, meaning the rates are really good. And FHA rates are typically 1/4 to 3, can be 3/4 of a point better than a conventional loan, like a Fannie Mae or Freddie Mac type loan. Minimum FICO score is 580. There are some lenders out there that I am approved with that can actually go lower than that, but you know, typically 580 is the minimum. Maximum loan amount on an FHA, you can go up to $970,800 in LA County, LA City, LA County. It's based on county. So and right now LA County is $970,800. Seller can pay all the closing costs and your prepaids if they want to. So this loan allows the seller to pay all that stuff, where on a normal loan there's a limit of how much the seller can pay. What's nice about FHA is you can qualify with a bankruptcy after 2 years. So if you had a bankruptcy 2 years ago, you can still get an FHA loan. And a foreclosure, you can still get a loan with a foreclosure that's at least 3 years old. On a normal conventional loan, Fannie Freddie, you have to wait 4 years on a bankruptcy before you can qualify, and 7 years before you can qualify on a foreclosure. So that's one of the unique features about FHA as well. Also, if it's a condo or a townhome complex, the complex has to be approved for FHA loans. So not all complexes are approved. So you have to check that with when you're working with a realtor. You got to make sure that if you are getting a loan with an FHA, that the complex you're making your offer on is FHA approved. If you're buying a detached condo, which means no shared walls at all, or a single family residence, you do not need FHA approval in the complex. In other words, if it is an association, but it has detached condos or houses, you do not need to worry whether or not the HOA is approved to do FHA loans. You can still get it. And then another nice feature about FHA loans is the debt to income ratio. That back end ratio can go above 50 depending on compensating factors. So compensating factors are like really high FICO scores, lots of reserves in the bank, you have lots of money in the bank, you've been at your job for a long time. There's a lot of different factors that can determine whether your debt to income ratio can go above the 50. Okay, why should you use a mortgage broker versus a banker? Well, let me tell you, representation is one. What's nice about the mortgage broker is they represent you and package your loan, highlighting your strengths and minimizing your weaknesses. So when we package a loan, I'm a broker, so we package it to make you look fantastic. Whereas a bank or a banker, they represent the lender, they're gonna just put it all together and send it in however the bank looks at it and not really focus on all your highlights and your strengths. Customization, mortgage broker offers a wide range of loan programs and with the most competitive adjustable and fixed rates, where a banker only offers very limited programs. They offer whatever they offer. You go to Bank of America, you go to Quicken, it's whatever they offer, that's all you can get. Where a broker has hundreds of different lenders they can send the loan to and different programs. Flexibility. This is really important, is a problem loan can quickly be moved from one lender to another with a broker. If you get declined by a banker, like if you go to B of A or Wells Fargo or Quicken and they decline you, you have to start the whole process over with another lender, meaning you have to rerun your credit. They won't use the credit report you already ran. You have to start all over, whereas a broker can use the same credit and just easily move your loan over to another lender that they're approved with. Availability. Mortgage brokers work weekends and evenings. I work holidays. I work on vacation. I've actually done things when I'm in Italy. So we work all the time. Bankers, typically you have to call them during the banker's hours. Whenever the bank is open is when they're able to talk to you. Professionalism. Mortgage brokers are familiar with many different lenders and many different programs, and we also all have to be licensed by the Department of Real Estate. So we have to renew our licenses every 4 years and take classes, where a banker is limited to the number of programs they offer, as well as they do not have to be licensed. They are under the license of the bank. So the bank basically is like an umbrella, and they don't have to take the classes and get their real estate license to be able to function as a loan officer. Performance, generally paid on commission. A mortgage broker, we get paid on commission. And of course we're motivated. We want to close the deal because we don't get paid. If we take your loan in and we do your loan, we don't get paid. Whereas a banker, they are generally paid on salary and then they get a lower commission. So if they don't close your loan and the incentive isn't as strong to close as it is with the mortgage broker, they still get paid because the bank pays for their health insurance, their dental insurance, whatever the case may be. The bank pays for those things, whether they close loans or they don't. They might fire them if they're not doing a good job, but they basically get a base salary typically. And then costs can, with a mortgage broker, we have numerous different rates and fee combinations, whereas a bank, of course, as I said, fits inside their box. They offer only a limited number of rates and fee combinations. Whatever their bank offers, that's what you get. Okay, last but not least, what to look for in a real estate agent. First and foremost, you need to realize you're always better off having an agent working for you than not having one at all. Because if you didn't know this, you do not, as a buyer, you do not pay for your agent. The seller, whoever's selling the house, is who's paying the commission on your agent. When they sell you a home, the seller pays the commission to the selling agent and to the listing agent. So, keep in mind that having an agent is always important because they protect you from, any wrongdoing that the seller might be trying to do or the selling agent trying to, the listing agent. After meeting with the agent, you should feel comfortable with their ability to find you a home. So very important, first impressions are everything. So if you feel comfortable with them after you meet with them, then that's a good sign that they could be, a good choice for you. But if you feel uncomfortable or you just feel, I'm not sure they know enough, or I don't know if they I feel comfortable with this person, then, move on to the next person. You don't have to choose every realtor you talk to. You got to make sure that you feel that they're a good fit for you and your family. They should also try to get to know you, your likes and your dislikes. They should ask you lots of questions. What kind of home are you looking for? Are you planning on raising a family? Do you have dogs? Do you like, outdoor activities? Maybe we need to try to find you a house that's near, walking trails or hiking trails, or, do you bike ride? All those things really make a difference on whether or not you're going to have the right agent working for you. And then finding a home on your own is frivolous. Agents can arrange a mapped tour of all the homes that are available in your price range. So you tell them what price range you're looking for, what amenities, you want a 4-bedroom, 4 bedrooms plus, you need at least 2.5 bathrooms, whatever the case may be. An agent can look that up and map out a tour of those homes that fit your exact needs. Whereas if you go to Zillow or Trulia or Redfin and you look for homes on there, you're just spinning your wheels, because all the information that they have on their websites, the Zillows and the Trulias of the world and Redfins, is all coming from the MLS, from the agent side. So you get much more accurate information when you work with an agent than you would with one of those online real estate companies. And then an experienced agent will always require you to pre-qualify with a mortgage professional before showing you homes. I prefer you get pre-approved, but if you get an agent that just you talk to and they're like, okay, let's go, and they didn't actually confirm and verify you're pre-qualified and look at the numbers with you and all that stuff, you're probably just spinning your wheels, because they obviously are not experienced and don't know that, showing you houses when you don't even know what they qualified for first is just a waste of everybody's time. So anyway, so that's what I've got to say. I hope if you guys do have questions, please feel free to respond in the comment section underneath. And if you are interested, I did write a book called Makers and Breakers, A Simple Guide to a Successful Mortgage Loan, and I'd be more than happy to send you a copy. Or you can go to loanmanjeff.com and actually buy one, or I can give it to you, whichever one you want. But again, thank you for attending, and happy house hunting. And again, please leave any questions or concerns down in the comment section, and I will try to get back to you. Thank you. Have a great day.